Think you need to spend hours on investment analysis to see significant returns? You might be surprised. In this video, I'll share how a simpler, more streamlined approach can often outperform the most detailed strategies. I'll tell you the wild true story of how the British Royal Air Force learned the best way to pick fighter pilots in World War II. And I will also talk about the 4 main reasons investors often underperform automated systems. Join me to discover the power of efficiency in investing and why less effort equals more gain. Hey friends, welcome back to the channel. If you are new here, I'm Cody Koch, a 25-year veteran investor, former hedge fund trader, and business owner. And on my channel, I like to talk a lot about investing, trading, and business concepts. So I'd like to start off by sharing a story of my early days as an investor. So this was back in college. This is about 25 years ago. And I just got into value investing and learned a lot about value investing, Warren Buffett's philosophy. And I started taking a great deal of time analyzing stocks, digging around. Back then, the internet was still young. We didn't have as many great stock screeners like we did today. So you still had to dig around a little bit more manually. But overall, we still had some pretty good opportunities. And the early version of these stock screeners definitely helped. Once I found an investment opportunity that I liked, I usually would drill down. I would learn everything about the business, everything about the industry. And at that time, to get a portfolio of just 20 or so stocks, I would spend probably 100 to 200 hours analyzing everything. Now, of course, I was new, and my thinking at that time was that that would actually add value, that I would on average do significantly better than I would if I didn't analyze my investments so much. Several years went by. I was doing really well. I was beating the S&P 500, very proud of myself, of course, as a young investor would be under this scenario, until I took the time to go back and analyze my investments that I had made compared to if I had simply used a very simple stock screener, how the performance would vary. And to my surprise, the simple stock screener would have actually outperformed my investments quite significantly. And so in other words, the 200 plus hours I spent to get simply 20 stocks in my portfolio, I could have probably saved at least 199 hours worth of my time and actually outperformed what I had done through all my analysis and work. In fact, this book right here, What Works on Wall Street, one of the earlier versions of this book I had read many years ago, and it actually does some fantastic analysis and gives you a wide variety of systems that still work to this day in most cases. And the performance in many of these systems is actually quite substantial. In many cases, they will produce 15 to 20% return per year going back many, many decades. Definitely a book I would highly recommend. And so what surprised me over the years is that simple rules like these often outperform some of the best investors and traders. Now, the reason this is the case, and it comes from different ideas, but one possibility is it's a variation on what's known as the principle of parsimony, often also referred to as Occam's razor, which is the simplest solution is often the best. You could also say this is a bit of the Pareto principle, in which 80% of the results are from 20% of the inputs. In my experience in the markets, this is generally pretty true. Now, this process of using highly systematized rules to make your investments is known as quant investing and sometimes referred to as algorithmic trading. Now, you can use this whether you're using computers or not. It can simply just be very much following very hard, strict rules that you have designed and tested. Now, this whole process of trying to simplify things in order to help us make decisions is not just used in the financial or investment world. One particular case comes to mind. During World War II, the British Royal Air Force was trying to figure out a method to allow them to predict ahead of time what recruits would be the best fighter pilots. They had a problem in which they were recruiting a large number of men into the Royal Air Force, training them to be pilots, and either those pilots would get themselves killed pretty early on, or they were too afraid to engage in effective combat that the Air Force needed. So a great effort was put forth in which they would have to analyze all the recruits in as much detail as possible in order to predict the highest chances of overall success. And they used many, many techniques. They used all kinds of personality techniques, physical attributes, family history, and so forth to try to predict who would be the best, until somebody actually discovered a very simple method that turned out to be the best predictor of future fighter pilots. They simply asked them 3 questions. The first question was, have they ever ridden motorcycles? Are they still riding motorcycles today? And if not, why did they stop? What they found were pilots who had started riding motorcycles but quit due to the risk became the best fighter pilots. That simple analysis tool would have weeded out a huge number of pilots that had either been too afraid to take on risks in combat to be effective soldiers, or had taken on too much risk and got themselves killed in combat. So let's take it back to the investing and trading world. Joel Greenblatt is considered one of the best investors of our time. He's had a lot of great success over many years. He's actually also the author of several books, including a book called The Little Book That Beats the Market. In that book, he had presented a system that he had tested very heavily known as the magic formula. The magic formula, historically speaking, has done really well going back to the 1970s. It does have periods of underperformance for several years, and then it outperforms quite substantially for several other years. But on average, the magic formula has done really well for multiple decades. The gist of the formula is to buy stocks that are very undervalued based upon their price to earnings ratio, but also have very high returns on invested capital within the company. Combining those two rankings together and having the best ranked stocks among them, picking among that list, you will often outperform the market quite substantially. But Joel decided to do an experiment. He took several volunteers who took their own money and self-managed their investment accounts using the list of Magic Formula stocks as their guide. At the same time, he also took some automated managed systems in which a simple algorithm picking stocks also from that same list of Magic Formula stocks. So both the self-managed and auto-managed accounts came from the same list of stocks related to the Magic Formula investing system. The results were very interesting. The self-managed accounts produced on average 59.4% over the course of a 2-year period. Not too shabby at all. Except during that same 2-year period, the S&P 500 had gone up by 62.7%, beating the self-managed accounts by just a few percentage points. However, the auto-managed accounts produced 84.1% return over that same 2-year period, beating both the S&P 500 and the self-managed accounts by about 20 to 25 percentage points. What was particularly interesting about this research was they actually found the best performing self-managed account was one in which the owner of the account opened the account, bought all the stocks, and just held on to them for 2 years. He didn't sell any of them. Now, why is this the case? Why did self-managed do so much worse than auto-managed? Because many of the self-managed owners spent a great deal of time, like I used to, analyzing the investments, trying to predict with as much accuracy as possible what was going to perform best in the future. According to Greenblatt's observations, there were 4 main reasons the self-managed accounts underperformed. The first reason is that self-managed investors avoided buying the biggest winners. The reason for this is that in many cases, some of the best performers actually look terrible at the time you buy them. Maybe they have a lot of bad news about them, sales and profits are declining rapidly, something looks really ugly. And so for that reason, many people try to avoid the stock. I learned my lessons when it comes to the hedge fund from this. During the day when something would start to crash terribly, we would start throwing in and buying shares along the way down, confident that at some point it would bounce back. And a large percentage of the time, somewhere around 70 to 75% of the time, it would bounce back sufficiently for us to make money. And our winners on average were the same size or larger than our losers on average using this method. So in many cases, some of the best long-term investments actually look really bad in terms of the stock market. Now, I want to say this, that's not always the case with a lot of other asset classes, so be careful using that in other types of asset classes, but in the case of stocks, it can absolutely work when the situation is right. The second major reason is that many self-managed investors actually changed their systems after they went through a period of underperformance. I've seen this a lot. In fact, I used to do this many years ago when I was still young and learning. I would change my system after a little while when I'd run through a bad period, not realizing that that is actually very, very normal. And so it's the same case with these investors. They did not realize that you actually have to stick to a system through long periods of drawdown or through long periods of underperformance in order to long-term get the overall returns that that system should perform. The hard part is that sometimes these long periods of underperformance can go several years, 5, even 10 years, a system can underperform. And then suddenly year 11, the system triples in value very short and catches up with all of those losses all that decade prior. I've seen a lot of crazy stuff over the years that has revealed to me that in many cases, a good system that's been well tested, you often have to stick it out with those systems and be patient with them because in many cases they do come around eventually. The third reason was that many self-managed investors would change their game plan after there was an overall decline in the market and their stocks, even if their stocks were still performing dramatically better than the overall market. They would sell their stocks and unfortunately not be able to participate in the resulting bounce. And the fourth major reason, and very likely the big reason, is that many self-managed investors would often only buy more after a period of good performance, but would then sell after a period of bad performance. So in a way, what these investors are doing is going against the golden rule of investing in the markets is cut your losses short and let your winners run. Instead, they were cutting their winners short and letting their losers run. What they should have done is actually stick to their system. Had they done so, over time, it would likely have performed well. In this video, I explained how simple systems can often outperform complicated systems in the investing and trading world. Towards that end, in a previous video, I explained 4 systems that you can use to beat the S&P 500. You can watch that video here. Now, if you enjoyed this video, please let me know by hitting that like and subscribe button to see more videos like this, and I will see you in the next video, and thanks for watching.